Have you ever looked at a company and wondered, how do you really know if it's healthy? I mean, sure, you can look at the profits, but that's just scratching the surface. Today, we're going to dig into how you can take a sea of financial data and turn it into a clear, compelling story. All right, let's dive in. So, a lot of the time, our main source of info is something like the balance sheet. It's been called a snapshot of what a firm owns and what it owes on any given day. But here's the thing. That snapshot can be super overwhelming if you don't know what to look for.
And this is usually what you get. For our explainer, we're looking at a company called ABC Enterprises. And, well, it's just a wall of numbers, right? Look at this. Can you tell me, right now, if this is a good investment? Is it about to go bankrupt? Is it run well? It's pretty much impossible to tell just by looking at the raw data.
So how do we make sense of it all? Well, the answer is ratio analysis. The best way to think about it is like a decoder ring for these financial statements. It's the tool that lets us connect all these different numbers, see the bigger picture, and finally understand the story that's hiding in all that data.
Okay, so let's start by putting on our first hat. We're an investor now. If you've put your hard-earned money into a company, you really want to know one thing above all else. Is my investment actually growing? Let's see which ratios can help us answer that. First up, we've got gross profit margin. This one's pretty straightforward. It tells you how much profit a company makes from just selling its core product. Before you factor in all the overhead like marketing or rent, it's a pure measure of how efficiently they make their stuff. And then you've got the net profit margin. This is the big one. This is the bottom line. After you subtract every single other cost, operations, interest on debt, taxes, the whole shebang, what's actually left for the owners? This tells you the company's true overall profitability. Now, here's where the story gets really interesting. When we chart these two for ABC Enterprises, we see a really weird contradiction. Their gross profit margin is going up, so they're getting better and more efficient at making their product, but their net profit margin, the money they actually keep, is going down. That's a huge clue. It tells us something after the product is made is eating away at all the profits. Could be high salaries, or, as we're about to see, it could be rising interest payments. And that brings us to what might be the single most important ratio for any investor: return on equity, or ROE. It answers a really simple but vital question. For every single dollar I've invested in this company, how much profit is it actually generating for me? It's the ultimate report card on management. And for an investor in ABC Enterprises, this is a massive red flag. Back in 2016, the company was generating over 33 cents of profit for every dollar of shareholder money. Awesome. But by 2020, that number had been chopped in half to less than 16 cents. The return on their investment has just collapsed. Okay, let's switch hats. Now, we're not an investor. We're a lender, maybe a bank that gave the company a loan. Our main concern is totally different. We just want to know one thing. Is our money safe? Are we going to get paid back? So to answer that, lenders always start with the current ratio. It's a really basic check of a company's short-term financial health. It just compares assets that will turn into cash soon, like inventory, to bills that are due soon, like payments to suppliers. In other words, in plain English, can the company pay its bills for the next 12 months? It's a fundamental test of whether they can keep the lights on. And at first glance, ABC Enterprises looks incredibly safe here. Its current ratio is 4.85. A general rule of thumb is that anything over 2 is pretty healthy. So they have almost $5 in ready assets for every $1 of bills they have to pay soon. Seems fantastic, right? But, and this is a big but, short-term safety doesn't tell the whole story. To get the long-term story, we have to see where the company's money is coming from. And there are really only two main sources. There's equity, which is the owner's money. That's less risky. And then there's debt, which is borrowed money. That's way more risky because you always have to make those interest payments, even if you have a terrible year. In 2020, ABC's debt-to-equity ratio was 2.36. Think about what that means. For every $1 the owners put in, the company has borrowed over $2.30. That's a lot of leverage. So as a lender, you look at this and you think, okay, yeah, they can pay their bills this year, but you'd be really worried about this heavy reliance on debt, which could make the company super fragile down the road. All right, for our last perspective, let's step inside the company and put on a manager's hat. Now, a manager cares about profit and debt for sure, but their day-to-day focus is on operations. Are the gears of the business turning smoothly and efficiently? A key metric for this is the average collection period. It asks a really simple question. After we make a sale, how long does it take to actually get the cash from our customers? Because the faster you collect, the more cash you have to run and grow the business. And here, whoa, we find another really critical piece of the story. In 2016, it took ABC about 83 days to get paid. By 2020, that number had exploded to 165 days. They are now waiting almost half a year to get paid for something they sold. That is a massive operational breakdown, and it's tying up cash that the company desperately needs. So you see what we've done. We've looked at this one company from 3 completely different angles. And the crucial takeaway here is that no single ratio could have ever told us the whole story. The real insight, the real aha moment, only comes when you put all the pieces together. So here it is, the complete story of ABC Enterprises. The investor sees that their returns are shrinking fast. The lender sees that sure, they can cover this month's bills, but their long-term debt is dangerously high, and the manager sees an operation that's just become incredibly slow and inefficient. When you put it all together, a very clear picture emerges. This is a company that's chasing growth at all costs, piling on debt and letting customers pay really late, and it's absolutely wrecking their profitability and their efficiency. And you know, in the end, ratio analysis doesn't really give you all the answers. Its real power is that it tells you exactly which questions you need to ask. So, looking at this whole story, what would you ask this company's CEO? Why are your returns for owners collapsing? What's your plan to handle this mountain of debt? And how on earth are you going to fix the fact that it takes you half a year to get paid? That's the real power of turning numbers into a narrative. Thanks for joining us.